Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. The events in Ukraine in the last few weeks have been devastating to watch, given the loss of life, the destruction of infrastructure, and the humanitarian crisis that has resulted. Our thoughts and prayers are with the people of Ukraine and for a resolution that ends the devastation quickly. Not surprisingly, the events in Ukraine and the subsequent sanctions on Russia have had a material impact on the financial markets and have added to an already complicated investment environment for 2022. Apart from the longer-term implications, the most pressing near-term impact has been the increase in oil prices, given Russia's position as the third largest oil producer in the world and the largest exporter to global markets. As you can see in the chart on your screen, the price of crude oil has surged to the highest levels we've seen in close to a decade, largely due to the expected impact of Russia being cut off from the global oil supply and lack of clarity on how that supply can be replaced. Outside of energy markets, agriculture prices have also surged, with wheat prices up around 40% year to date, as Ukraine and Russia together supply nearly 1/3 of the world's wheat and barley supply. These commodity price shocks are having an immediate impact on prices at the gas pump and the grocery store, at a time when inflation was already running hot. If prices for food and energy stay at these levels for too long, consumer spending and confidence will almost certainly be impacted, and the Fed's job of reining in prices will become that much harder. Our base case expectation remains that the U.S. economy will slow but not face recession in 2022, and that financial markets will continue to climb the wall of worry once current geopolitical fears recede. The fundamental underpinnings of the U.S. economy remain in solid position, with tight employment and housing markets and corporate earnings still set to expand in 2022. Having said that, the events in Ukraine do create longer-lasting implications, including a shift away from globalization, which could bring jobs back to the United States, but could also lead to sustainably higher inflation levels. Defense spending is also likely to see a boost, as world governments are now having to assess the security of their own borders. Along those lines, the Investment Committee and MAI continues to look for ways to protect portfolios at the margin, including in areas like defense stocks, structured notes that offer embedded downside protection, as well as assets like real estate and infrastructure and other hard assets that can protect portfolios in periods of higher inflation. But the critical takeaway amidst the heightened volatility today is that markets have been here before. The chart on your screen shows the performance of the S&P 500 index since the Great Depression, which includes the period during World War II, the Vietnam War, the Cuban Missile Crisis, 9/11, and the Iraq War, amongst many other geopolitical events. The critical point is that the equity market has produced positive long-term returns in a variety of economic, geopolitical, and monetary cycles, and we don't believe this time will be any different. This implies that investors should adhere to their strategic plan in periods of heightened volatility like this, and avoid turning any temporary losses into permanent ones. We realize this is easier said than done, so we value the opportunity to partner with you in setting up a game plan that we believe can meet your long-term goals and objectives, and helping you stay the course in periods of volatility like this. As always, we would encourage you to reach out to your wealth advisor with any questions or to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.